Whatever the seller is willing to agree to is what can be negotiated. The investor pays the seller the difference between the current market value of the home and what's left on their mortgage, and then takes over the existing loan. So as an example, we have a home valued at $125,000, seller owes $100,000. We bring in $10,000 cash to the seller, we take over the $100,000 mortgage, we become the new owner. It works because it's great for sellers facing foreclosure or who need to walk away fast, and perfect for investors looking for low money down deals. Now, obviously, there's not a lot of houses out there for $125,000, which is why I'm going to give you some case studies of how this works. Okay. Now, the seller can finance part of the deal by carrying back a second loan or a promissory note. So for those of you going, well, Lee, I don't have $10,000. How do I do it? Well, if we have a home worth $200,000, the seller owes $150,000 on their mortgage, but you, the investor, don't have the $50,000 difference, you can have the seller allow us to take over their first mortgage of $150,000 and then do a seller financed second for $50,000 as a second note. You take over the $150,000, they carry the interest at say 3%, or it could even be 0%. Guys, you can structure this however you want. So you can do a $50,000 note with no monthly payments, no interest accrued until the property resells for up to 120 months, 240 months, 10 years, 20 years. Whatever the seller is willing to agree to is what can be negotiated. Okay, now here's why this works. The seller gets monthly income instead of a lump sum. So the couple that we're buying the triplex from, the reason they want to sell us the triplex is they don't want a lump sum of cash. They don't want all of this cash because then they got to figure out what to do with it. So they're like, you know what? You pay us what we paid for it. We'll carry the balance at 1%. And they want to do that on a 30-year note with a 10-year balloon. Now, again, at 1%, even with the elevated price, the monthly payment is still significantly lower than the rental income, and we can collect the rental income. Now, what we will do is structure the deal, close the deal, and then resell the deal to another investor and simply carry the financing and wrap the 1% note with the seller and charge the new investor 8 or 9% when we carry financing for them. So now we're making that 6 or 7% delta between the seller financed and what we seller financed it at. Now, this is what's called a subject to deal, where we're getting seller financing, we're selling it subject to. So it all works. The investor gets in with no bank or low upfront costs. Everyone wins. Okay. Now, the investor agrees to a new higher interest rate loan that wraps around the seller's existing mortgage. Example, we find a seller that has a property with an existing mortgage rate of 4%, and we tell them, look, if you will carry the financing for us so that we don't have to bring in cash, we'll pay you 6%. So, seller makes their 4% payment to the lender and keeps the 2% spread. This is best when original loans have low fixed rates and the seller wants a passive income stream.